In this video, we'll be looking at recording inventory in the inventory cards. But before we do that, let us revisit the movements of inventory. Using the inventory warehouse as a visual prompt, we'll be looking at some transactions that lead to inventory coming in and going out of the warehouse. The first one is purchases. When we make purchases of inventory, this leads to inventory coming in to our warehouse. When we return the purchases to the supplier for whatever reason, this leads to inventory going out of the warehouse. When we make a sale to a customer, the inventory also goes out of the warehouse. And when the customer returns to us inventory, the inventory comes back in to the warehouse. Another transaction is a capital contribution from the owner. This is when the owner contributes inventory to the business. In this case, the inventory comes in to the warehouse. The owner may also withdraw inventory for personal use, and in this case, inventory will be coming out of the warehouse. Another transaction could be advertising, where inventory is withdrawn to be used for advertising, and in this case, this would lead to inventory coming out of the warehouse. In this video, we'll be focusing on recording the transactions in the inventory cards. First, let us explore some of the features of the inventory card. This is an example of an inventory card. Here at the top, we list the details of the inventory, including the cost method, which we'll be talking a little bit more in detail in this video. Here we record the date of the transaction, followed by the document identification number, which relates to the transaction. So this could be things like check numbers, invoice numbers, and receipts. So whenever there's inventory coming in, this is where we record the details of the inventory coming in, which includes the quantity of the inventory, the cost per unit of the inventory, and the total cost of the inventory coming in. Here is where we record any inventory going out. And lastly, here is the balance of the inventory on hand. Before we start recording in the inventory card, there are a few things that we need to take note of. Firstly, we only record cost prices of inventory coming in and going out. No selling prices in the inventory card. Secondly, no GST is recorded or included in the inventory card. Remember that GST are amounts payable or refundable from ATO. Next, there are different methods for recording inventory. The first question we ask ourselves is, are cost prices changing? In other words, from one batch of inventory to another batch of the same inventory purchased from the supplier, we are seeing whether the cost prices have stayed the same or if they have decreased or increased. If the cost prices are not changing, we use the first method, which is the constant cost price method. However, if the cost prices are changing, we can choose either one of two methods. The first one being the Identified Cost method, and the next one being the first in, first out FIFO method. Method 1 is for constant cost prices. We use this method when we are recording the inventory cards when cost prices are not changing. Here we'll see what it means by non-changing cost prices. Let's assume that we have a balance of 3 units at a cost price of $10 per unit in our warehouse. Then we purchased another 3 units at a cost price of $10. Note here that we didn't actually purchase a new type of inventory. We're still purchasing the same type of inventory. It's just that from the first batch to the next batch, the cost prices have not changed and they remain the same at $10. Assuming we sold 2 units of inventory to a customer. Now it doesn't matter which units the customer actually took from us, because they all cost $10 anyway. Now we're going to record in the inventory card a purchase and sale of inventory using the constant cost price method. So on the 1st of July, we have a balance of 5 units of inventory on hand with a cost price of $10 per unit. On the 5th of July, we've purchased 10 units at a cost price of $10 plus GST per unit. So in the inventory card, we record the date, the document ID, which is invoice 123. And because this is a purchase, the inventory is coming in. Here in the in column, we record the purchase of 10 units with a cost price of $10 per unit. In the balance column, we update to show 15 units on hand with a cost price of $10 per unit. Now on the 8th of July, we have sold 2 units. So we write the date, the document ID, which is receipt 32. And because this is a sale, it means that 2 units are going out of our inventory warehouse. So in the inventory card, we record in the out column 2 units that were sold with a cost price of $10 per unit. Our balance is now 13 units on hand with a cost price of $10 per unit. So note how the cost price of the balance that we had on hand on the 1st of July was $10 per unit. And when we purchased more inventory on the 5th of July, it was still the same with a cost price of $10 per unit. When we sold, the 2 units also had a cost price of $10 per unit. So with this constant cost price method, the main idea is that all inventory costs are the same. The identified cost method is used to record in inventory cards when the cost prices are changing. Here in this example, we start off with a balance of 3 units at a cost price of $10. Then we purchased another 3 units, but this time the cost of inventory has increased to $15 per unit. Assuming we sold 2 units of inventory to a customer, the problem is, how do we value the cost of the 2 items sold? With the identified cost method, we are valuing inventory by physically marking each item so that each individual cost price can be identified. In other words, we know exactly the cost of each item heading out the door. Here in this example, we have 3 units at a cost price of $10 per unit, and we also have another 3 units with a cost price of $15 per unit, and these have been marked with stars. Assuming we sell 2 units, and a customer has picked out one without a star, which has a cost price of $10, and one with star with a cost price of $15 per unit. So in this case here, we can work out the exact cost prices of the 2 units that have been sold, which totaled to $25. In reality, we do the markings on this inventory by using a barcode. Here we're going to use the identified cost method to record a purchase and sale of inventory. So we start off with a balance of 5 units at a cost price of $10 per unit. On the 5th of July, we purchased 10 units at a cost price of $15 plus GST per unit. So remember what I said earlier, that we're actually not purchasing a new type of inventory. We are still purchasing the same type of inventory. It's just that the cost of inventory has now increased to $15 per unit. So we firstly record the date followed by the document number. And because this was a purchase of inventory, we have inventory coming in. In the balance column, we need to firstly record the balance from our first batch, which was the 5 units at a cost price of $10 per unit. Then we write our newest batch of inventory purchased, which was the 10 units at a cost price of $15 per unit. Our next transaction is on the 9th of July, where we've sold 4 units at a selling price of $30 plus GST per unit. So remember that we don't record selling prices in the inventory card, just the cost prices. And here we have the identified cost prices of the 4 units sold as $15 per unit. Because this was a sale, we therefore have 4 units going out at the identified cost of $15 per unit. Because there weren't any changes to the first batch of inventory that we had, therefore we just bring forward the balance as it is. And our 4 units of inventory that were sold were coming out from our newer batch of inventory, which had a cost price of $15 per unit. So in this case here, we are updating our balance to show 6 units at a cost price of $15 per unit. The main idea that we need to remember when we're using the identified cost method is that all movements of inventory are clearly identified. The next method is the first in, first out or FIFO method, which is also used when the cost prices are changing. I'm going to explain to you the idea behind the first in, first out FIFO method using the milk shelf. This is the top view of the milk shelf. Newest inventory is usually stocked on the shelves from the back. When the customer comes to buy milk, they usually grab the ones from the front. So we can safely assume that the oldest inventory is usually sold first. This is the rationale behind the first in, first out method. With the FIFO method, we are valuing inventory by assuming that the first items purchased are the first ones sold. Therefore, inventory sold is valued at the earliest cost price on hand. In simple words, we assume that the old stuff goes out first. Here in this example, we have a combination of old and new batch of inventory, with the old batch having a cost price of $10 per unit and the new batch having a cost price of $15 per unit. Assuming we sold 2 units to a customer. Now it doesn't matter which 2 units the customer has picked out. What we are doing here with the FIFO method is to assume that the 2 units that the customer purchased were from the old inventory, which had a cost price of $10 per unit. First, we'll look at how we record purchases and purchase returns using the FIFO method. We start off with a balance of 5 units at a cost price of $10 per unit. On the 5th of July, we purchased 10 units at a cost price of $15 per unit. As what we've done earlier with the identified cost method, we just need to make sure that our balance column reflects the 2 batches of inventory that we now have. On the 8th of July, we returned to our supplier 2 units that were purchased on the 5th of July. And here we have 2 units going out. Because the 2 units that we've returned related to the purchases that were made on the 5th of July, there weren't any changes made to the first batch of inventory that we have. Instead, the 2 units that were returned related to the inventory that we've purchased on the 5th of July, which had the cost price of $15 per unit. So here we now have a balance of 8 units at a cost price of $15 per unit. So what we can see here is that the purchase returns are recorded based on the inventory that was purchased. There's no difference in the way we're recording compared to the other methods. Here we're going to see how we record sales and sales return in the inventory card using FIFO method. Here we can see that we have a balance of 2 batches of inventory, with the old batch being 5 units at a cost price of $10 per unit. And in our new batch, we have 8 units at a cost price of $15 per unit. So on July 10, we are selling 7 units at a selling price of $30 plus GST. Again, just another reminder, we are only recording cost prices of the inventory sold or returned in the inventory card. We do not use selling prices. So here we go. On the 10th of July, we record the document ID. And now in the out column, we have to decide which cost prices we are going to use to value the inventory that we have sold. Now, because we are using first in, first out method, we are assuming that the old batch is sold first. So in this case, we are assuming that the 5 units at a cost price of $10 per unit are being sold first. And we record them in the out column, which leaves us with a balance of 0. Now, because we are selling 7 units to the customer, we now have to record the balance of the 2 units that were sold, and they are coming from the newer batch, which had a cost price of $15 per unit. So here in the out column, we record the sale of the 2 units at a cost price of $15 per unit, leaving us with a balance of 6 units at a cost price of $15 per unit. Now on July 13, the customer returns to us 3 units sold on July 10. The question is, what is the cost price of the inventory that was returned to us? Was it the $10 or the $15 per unit? Now the rule of thumb is, with sales return under the FIFO method, we need to look at the last cost price that was recorded in the out column. So in this case, it was the $15 per unit cost price. So we're going to assume that the 2 units that were returned to us from the batch which had the cost price of $15 per unit. Now because the customer has returned to us 3 units, the remaining balance of the 1 unit is assumed to be at a cost price of $10 per unit. So here we update our balance column accordingly with a balance of 1 unit at a cost price of $10 and a balance of 8 units at a cost price of $15 per unit. Now, just remember with FIFO, we are always assuming that the old inventory goes out first. For other transactions such as drawings of inventory or inventory used for advertising, the same theory applies. The older inventory is withdrawn first, or the older inventory will be taken and used for advertising. I'm going to use an example here to make a point about recording sales returns using the FIFO method. Here we can see that we've got balance, a sale on the 10th, and drawings on the 11th of the month. Now on the 13th of July, the customer has returned 4 units sold on the 10th of July. So this is a sales return for the business, and I'm going to start by recording the date and the document ID. Because this is a sales return, we know that inventory is coming back into our business and will need to be recorded in the in column. Now the big question here is this: which cost prices should we use to value the inventory returned to the business? Because currently in the inventory card we can see 2 cost prices being used, and that's $10 and $15. So for this, we need to refer to the FIFO guidelines, which says that when we are recording sales returns, we need to look at the latest transaction recorded in the out column. And in our example here, we've got on the 11th, drawings recorded, and that's a withdrawal of 1 unit at a cost price of $15. So for one of the units being returned to our business as part of the sales return on the 13th of July will be valued at $15. But that's not enough because we know that 4 units were returned. So what we need to do next is to look upwards at the transaction prior, and here we can see we've got another 2 units at a cost price of $15. So in total, we've already valued 3 out of the 4 units returned to our business on the 13th of July. That's still not enough because we haven't valued the 4th unit. So again, we move upwards and look at the transaction prior, and this time we can see that we've got inventory valued at $10, and for this, one of the inventory being returned to us will have the value of $10 per unit. Now let's check this again. We have 1 unit at a cost price of $15, add another 2 units with a cost price of $15, and add another 1 more unit with a cost price of $10, and that's going to be the total of 4 units that are returned to our business on the 13th of July. Now let's record this in the in column. 3 of the units will have a cost price of $15, and 1 of the unit will have a cost price of $10. That makes up the total 4 units that were returned to us. Now what you will notice here is that I've written the $10 cost price unit on the line above because I recognize that as the older inventory. Lastly, let us update our balance, and here we have brought back in 1 unit at a cost price of $10, so that's the older inventory written at the top. And next we have 5 units here. Adding the 3 units returned to us, we now have 8 units at a cost price of $15. That's a total of $120. In summary, to determine the cost prices of the inventory returned to the business, which is recorded as a sales return in the in column, we need to refer to the latest cost price recorded in the out column, and you work upwards if you must. It doesn't matter if the out transaction we are referring to was a sale, drawings, advertising, or purchase return. Here's the last reminder about FIFO. We are only assuming that the old batches of inventory are sold first. Do we actually know if the inventory was in fact from the old or new batches? No. It is only an assumption for recording purposes.